Hey guys, Crypto Sam here. In today's video, I just want to go over two topics, market psychology and market cycles. Now, these are two big topics if you're getting into trading, whether it be financial markets, whether it be cryptocurrencies, stocks, whatever. These two topics are vital. Now, the reason why these topics go over all the different markets, regardless of what you're trading, is because there is a common factor between all these markets, and that common factor is humans. Now, the patterns you see on the charts, they aren't random. They aren't random patterns. In fact, you'll probably notice this already. If that charts go up and down, I won't insult your intelligence, you will most likely know that charts go up and down. And the reason why the charts go up and down is not due to some random feat of nature. It's actually due to the emotions and the actions of humans, the participants in the market. Now, it may seem very, very simple enough, but honestly, this is what causes a lot of traders to slip up, is not really understanding what's going on, or knowing about it but not understanding it. That's very, very two different things. You can know about a market cycle, but you can still be beaten out of it many, many times because of the emotions. Your emotions, if you can't control them, you'll be very, very likely to make mistakes. Now, this is what this picture goes across. It shows all the different emotions on different points in the market cycle. Now, it shows right at the beginning of a market cycle. A lot of traders will see the market, because you've got to bear in mind at this point down here, the market would have probably been down, accumulating on the floor for a very long time. Call it a few months, could be 1 month, 2 months. It depends on the market, could be even longer. So at this point, a lot of traders will be feeling that the market isn't going to go up again. They'll be feeling, that it's going to stay down for much longer. Then what you're going to get is you'll get a nice bump upwards and then another drop downwards, which is shown perfectly here. And then people will start to feel that, this isn't going to work. It's dropped down again. It's going to go further down and keep going on. The next thing you know, it goes up. That's when people start to feel, all right, maybe it's going up. And then there's optimism, and I won't go through all the things, but what the main fact is on the way up, it shows the transition from traders feeling that, it's not going to go up, to it goes up to the top here, and they're so happy with the rise up, and they're feeling that it's going to go up and up and up, and that's when you get to the euphoria stage. Now, when it drops down again, this is what a lot of people mess up with, is that they get the drop down and there's a bounce back. Now, this bounce is called a dead cat bounce. When you get a drop down with that kind of magnitude, that massive spike down here, this is a very, very big sign that the market is going to start dropping, that it's going to turn from a bull market. Now, this rise up is called bull, into a bear market. This is a big sign. Now, you usually get a bounce up, but then traders usually, I wouldn't call it a trader, but I'll say a participant, because a lot of people will be trading these markets, but they won't, they might have seen these charts or seen it time again, but they won't really understand it. So they'll see it bounce up and they'll be thinking, it's going to carry up again and keep rallying, hence the complacency stage. However, it drops down through and then people start panicking, they start selling, and that's what causes the market to drop. So it's all human emotion that cause these cycles. Now, another thing to take into consideration is during these cycles as well, not only the participants inside the market will be reflecting these emotions, but you'll also get people outside the market who will be showing the emotions of the market cycle. Now, when I say that, I'm referring to media, news articles. You'll get a lot of news articles at the bottom here that will be saying the market is, dead. Say, for instance, Bitcoin. In 2015, Bitcoin had a bear market that lasted a year or two. Had a lot of articles. In fact, I pulled up an article earlier. There's a website called 99 Bitcoins, and there's a section in it called Bitcoin Arbitraries, and it pulls up all the different articles of when people have said Bitcoin has died, and they've made these silly news articles when Bitcoin has dropped down. And currently to date, they've found 144 times that people have made these articles. Now, you'll find that these articles come up more and more during phases where Bitcoin is accumulating, where it's at the floor, at the disbelief stage. Just to show you this, guys, this is in summer 2015 when Bitcoin was right at the bottom of its bear phase. You had articles like Bitcoin is unsustainable, the death of Bitcoin, Bitcoin isn't the future of money. So I'll show you this on the chart as well so you guys can get an idea. So that would be around summertime of 2015. So that's right at the bottom of that bear market. You can see here that Bitcoin had its full cycle, it had the ride upwards, it had the down, it had that dead cat bounce that I mentioned earlier. So I don't know why I had the line tool on there. Had the dead cat bounce that I showed you guys, and then it had the drop down there. So it's pretty much identical to that picture that I showed you guys earlier, like very literally identical. So it drops all the way down, and at the bottom of his phase around summertime, July, you get all of these articles, death of Bitcoin, if Bitcoin. Now, if you aren't aware of market cycles, you would read these articles and you'd think, oh, I need to get out of Bitcoin, and you may go and sell your Bitcoin, and next thing you know, the market's gone up stupid percent. And this is why it's very, very important to understand what the market is doing. Now, what usually tends to happen is at that bottom of that stage, like I said, they have all that news saying Bitcoin is dead, etc., etc. However, as the market starts to pick up pace, and it's usually when it goes past the previous high, is you start to get different kind of articles, which I have pulled up another one, and it's around May 27th. So literally it's at the time that Bitcoin beats its previous all-time high, you get these sort of articles. So this article says Bitcoin could hit $100,000 in 10 years, which it pretty well could, but you didn't get these kind of articles when it was at the bottom. Now this goes and coincides perfectly with this chart. You know, when it gets this optimism that, oh, it's going to go up and up and up, we're going to get rich, and that's exactly what you've got here. Now this is when people start to buy, it fuels this ride upwards, and that's what causes the market to rally. Now, understanding this, guys, is very, very, very important. Now, something to keep in mind as well is that these market cycles don't only just occur in longer time frames, but they occur in all types of time frames. In fact, I like to think of these cycles as kind of like waves. So they're waves that go up and down, up and down, up and down, with more and more velocity now, magnitude in each one. Now I'll show you this on a different chart that I've pulled up. Now this is Digibytes. Digibytes had an absolute tear in this last market cycle, and that was from around late May to July. In fact, it did around 40,000%, 46,000%. 1 month, that is more than impressive. What I want to show you guys is that happened in May, June. However, if I scroll along, you will see, we're gonna have to refresh this page, COINBASE is messing up. You will actually see that this market cycle has happened before, but on a lower time frame. Once it's loads up, I will show you guys. Now on a smaller time frame, I'm going to take this all the way back to 2016. That was around this last market cycle. You will see that this exact cycle happened before, but on a lower time frame. And here we are. So this was in 2016, between February and April, again a 2-month time frame, and Digibytes went from around 26 sats all the way up to 180 sats. This percent move was around 500%. So a tenth or even a bit more than that than what the market cycle was recently. Now what that shows is that the market cycle that happened recently had higher magnitude than the one before. So when you're thinking of market cycles and looking at market cycles, this is why I tend to picture them as waves that go bigger and bigger on each uptrend. So something like this. Not a very great annotation, but you guys get what I mean. God, that was a terrible annotation. But yes, market cycles are like these waves that go small wave, and then bigger wave. They go up and up and down. That's in a healthy market. That is how the market goes up. And this is irritating me a little bit. I'm gonna have to redo that. But that is how markets rise. There's market cycle upon market cycle, and not only just in that time frame. If you go on smaller time frames as well, you can see what I mean. So that was in the daily time frame, but then even we do in a 15-minute time frame. You'll see in shorter time frames the same thing happening. Again, market cycles. Now this is in the bear trend, so I'm trying to show you guys in the uptrend. It's much easier to see. Right, COINBASE charts really don't want to work with me today. But yeah, guys, basically what I'm trying to show you is that these trends also happen. You can see here on Bitcoin actually in short term as well. You can see here how it goes up, just here up and then down, and then up and then down. So you have these waves in smaller time frames as well. Now, when you're able to realize and control your emotions with these kind of drops and these patterns, then it really ups your trading game. Honestly, trading is 80%. Managing your emotions that come out with trading at these points when it's going down, using your technical analysis to know that, you know, it's gonna hit a certain point and start riding back up. If you're going into trading and you're not too sure how to measure these levels, or you're not very well at managing your emotions, because some of these drawdowns can be a long time. Like Bitcoin here dropped down for, even though it's a big time frame, this is quite a long period. So that's from the 2nd of March till nearly the end of March. So that's nearly 2-3 weeks that Bitcoin had this choppy and down phase. Now, people who aren't too familiar with market cycles may think, oh no, it's going to start going down again, and they'd sell down here right before it rallies all the way up again. And then here, this is just recently this summer, Bitcoin had a choppy phase going down. However, it didn't have that really aggressive spike downwards. This is what really showed me. This is why I stayed in Bitcoin. I didn't think it was going to become a bear market. It's because this spike down just didn't have enough velocity. If you see in this chart that I showed you guys earlier, you know, when you know you're going into a bear market, is that spike down was aggressive. It's a really aggressive spike down. However, in the Bitcoin chart, it just wasn't. It bounced right back up and it trickles sideways, and it even rise back up and continue to go upwards. And this occurred in, you know, that was a month's time span, month and a half time span. So, you know, if you weren't comfortable about market cycles, you may have thought that was going to go down, and you would have sold, and you would have lost out on that rally here. So yeah, guys, just a quick introduction to market cycles and psychology. Hope you guys learned a bit from that. Thanks for watching this video, and take care.